Imagine this. You own property in the UK. Maybe one, maybe three. You've dealt with tenants, repairs, mortgages, insurance, regulations, the whole lot. You did everything right. You took the risk because you believed that long-term property would reward you. You believed that rising rents and stable house prices would give you financial security. But instead of feeling wealthier each year, you feel pressure. You feel the tax bill growing. You feel like the more you earn, the more the system takes away from you. And for thousands of landlords across the UK, this story is becoming painfully familiar. Today, I'm going to show you what most landlords will never know: how some UK property owners legally reduce their tax burden dramatically, sometimes almost to zero. You're about to understand the structures, the hidden levers, the timing, and the realities behind the strategies that the most tax-efficient landlords use. These aren't loopholes, they're legal frameworks, but only if you understand them and use them correctly. Before we begin, this isn't personalized financial advice, it's education. But if you act on anything here, make sure you consult a qualified professional. Now, let's start with the reality of being a UK landlord in 2025. The average UK private rent is about £1,354 per month, roughly £16,000 per year from one property before costs. Rent is rising at around 5 to 6% a year. The average UK house price sits around £273,000. On paper, that looks fine. Rents rising, property value steady. But here's the trap. The UK tax system is quietly squeezing landlords harder every year. Your personal allowance is still frozen at £12,570. The higher rate threshold is still £50,270. And the additional rate threshold is £125,140. And those freezes are scheduled to stay until 2028, which means even if your real purchasing power isn't increasing, your taxable income is.
Let's say you earn £60,000 from your job and £25,000 net from rental profit. You've just pushed yourself into higher rate taxation. If you get a raise, or rent increases, or you add another property, you start losing your personal allowance. At £125,140, you lose your personal allowance entirely, meaning you're effectively paying a marginal rate of over 60% on some income. Add the mortgage interest restrictions, where you no longer deduct interest fully, you only get a 20% credit, and suddenly a strong rental business becomes a tax headache. But here's the truth: you don't have to remain trapped in this structure. There are 5 major levers that sophisticated UK landlords use to dramatically reduce their tax burden. Most people will only ever use one of them. A few use 2. The truly strategic investors combine all 5 over time, and that's how they create long-term, tax-efficient wealth. The first lever is a deed of trust. This is the simplest, fastest way to reduce tax without changing legal ownership. You keep the property in your name, but you assign some or most of the beneficial interest to someone else, usually your spouse or civil partner. Why does this matter? Because beneficial interest is what determines who pays tax on income. If you earn £60,000 from your job, and your spouse earns £15,000, and your rental profit is £40,000, you could legally allocate 50%, 70%, even 90% of the rental income to your spouse, depending on contribution and structure. Instead of you paying 40% on the majority of it, your spouse might pay 20%. That alone can save thousands per year. And it's fully legal, as long as the documentation is correct. The second lever is forming a partnership. This is where your property holdings become a business shared between you and your spouse, or another partner. A properly formed partnership allows you to allocate profits in any agreed ratio, and this flexibility lets you optimize for lower tax brackets each year. It also strengthens your status as a genuine property business in the eyes of HMRC. Partnerships allow you to formalize who pays what, who receives what, and how profits are shared. For many landlords, this step alone can save £5,000 to £10,000 a year.
Inside the company, you have two powerful tools. You can reinvest profits tax efficiently, and you can grow the business without being dragged into higher personal tax bands. But there's another lever most investors never learn. The fourth lever is pension contributions. When you run your property through a limited company, the company can contribute to your pension as an employer contribution. These contributions are tax-deductible for the company. That means they reduce company profit, often significantly, and lower your corporation tax bill. Many landlords use this method to bring their taxable company profit down close to zero in some years. Meanwhile, the pension grows tax-free. This is one of the most powerful compounding strategies available to UK investors, and yet almost no landlord does it. The fifth lever is long-term estate planning, trusts, share classes, and inheritance tax planning. Once your property sits inside a company, you're dealing with shares instead of individual assets. Shares can be gifted, frozen in value, or structured so the next generation benefits from future growth without triggering major taxes. This is how portfolio landlords build generational wealth and how families avoid the massive inheritance tax burdens that wipe out estates. Now, let's zoom out. Why is 2025 such a crucial moment to understand all this? Because rents are rising fast, house prices are relatively stable, but tax thresholds are frozen. Every year, more landlords are pushed into higher taxes, even if their real profit isn't increasing. Without proper structure, your returns shrink. With proper structure, your returns expand. And because many landlords will never adapt, the ones who do gain a huge advantage.
But these strategies aren't for everyone. They require discipline, they require paperwork, they require proper documentation, bookkeeping, and professional oversight. If you treat a partnership or company casually, HMRC can and will challenge you. Extraction tax from a company must be planned carefully. Mortgage lenders can be more cautious with companies than individuals. Selling properties inside a company is different from selling personally, and tax laws can change, so you must stay informed. That's why the landlords who benefit most from these strategies are those with 2 or more properties, long-term plans, a spouse or partner with lower income, and the willingness to treat property as a real business rather than a passive side project. To illustrate the power of these levers, imagine a landlord earning £55,000 from their job with 2 buy-to-let properties earning £36,000 net rental income. Owned personally, that landlord pays around £14,000 in tax on the rental income because they're pushed deep into higher-rate taxation. But if they share rents with a spouse through a deed of trust, then transition into a partnership, then incorporate using Section 162 relief, and finally run the properties through a company using pension contributions to reduce profit, that same investor could cut their tax bill by tens of thousands of pounds over the next decade. They could reinvest more, grow faster, and build a far larger portfolio than someone paying full tax each year. Most landlords will never discover this. They assume the tax they're paying is inevitable. They assume structure is expensive, complicated, or unnecessary. They assume property should be simple. And that assumption is exactly why they stagnate while others build generational wealth. If you want more content breaking down advanced UK property strategies, market trends, and smart investing frameworks, make sure to subscribe. And remember, tax planning isn't about avoiding responsibility, it's about understanding the rules of the system you're playing in. Because in the UK, the rewards aren't given to the people who work the hardest, they're given to the people who structure the smartest.